Good afternoon, everybody. My name is Brian Treese, and I am honored to be the president and CEO of the Findlay-Hancock County Community Foundation. Welcome to the 2020 Investment Briefing. Today is my third day in this new role, and I am looking forward to seeing all of you in person and learning more about your passions and interests soon. As a community, we work best when we work together. I know the Community Foundation can partner with you to make the greatest impact possible. Today, we are hosting our first ever virtual briefing. A few housekeeping items. There is a chat box to send messages directly, as well as a Q&A option. We will take questions at the end of the presentation, but please submit them as you think of them. This meeting will be recorded and the link will be shared afterwards. I'd like to introduce the Foundation's Finance and Investment Committee. This group stewards the Community Foundation's assets by reviewing financial statements and reports, safeguarding the organization's assets, and monitoring investment performance. The members are Chairperson Gary Pfeiffer, Tom Donnell, John Haywood, Ginger Jones, Ron Pfeiffer, Alec Reinhardt, and Chuck Younger. Myself and our CFO, Richard Brown, are members ex officio. Should you have any questions after today, Richard and I would be happy to answer them and confer with this committee as needed. At this time, I am pleased to introduce Bill Hummel. Bill is the Foundation's investment consultant and is managing principal at Fund Evaluation Group. He has 30 years of investment experience and has been with FEG for 25 of those years. Bill, the virtual floor is all yours.
Thanks, Brian. Appreciate it. I apologize for a little bit of the background noise there. They're doing the first of the Wednesday of the month testing of the emergency broadcast system. So you might hear a little bit of that in the background, but appreciate everybody's time today, making themselves available virtually here. And certainly we'll have Q&A at the end of the presentation, but the format of the presentation will look essentially as follows. We'll kind of briefly go through the investment philosophy that our firm has and certainly partners up with the Finance and Investment Committee. Touch on some of the current market environment as it relates to the market behavior, since we've come quite a far way since March, and certainly the volatility of the markets back then to now, and we'll share that. As well as some key macro developments, and then wrap up with some information on the foundation itself in terms of asset allocation, the managers or strategies that we're utilizing, and then obviously the performance as well. So with that, just talking about the investment philosophy, 4 main categories here. We try to keep a long-term perspective with the investment approach, knowing that these foundation monies are really managed in perpetuity. So we're really trying to not only affect change for the community today in real dollars, but also 50 years, 100 years from today as well. Certainly valuation considerations drive our investment decisions. I think the biggest challenge right now in the marketplace is that there's not a lot of screaming value or undervalued situations out there in the marketplace. We certainly saw a pullback in March, but certainly we also saw the snapback as well. And so I'll kind of make some examples there in terms of valuation and kind of tie that to that. That said, though, when value isn't presently available in all the asset classes, we tend to be a very diverse approach towards investing. And so we diversify based on global risk factors, and we'll touch on that as well. And then finally, on the investment philosophy, we look to add value in certain asset classes or strategies where we see active management add some value over the respective index. And then, of course, if that isn't the case, we'll tend to index as is the case in, say, mid-cap or domestic large cap in the U.S. Within the diversification of global risk factors, we typically break down the investment universe in 4 broad categories. So global equities would serve a certain role of total return for the portfolio. And then obviously equities have their own inherent risk, ups and downs in the market that we experienced so far historically, but also more recently within just even the last 6 months. And so, we look at global equities as one group, whether it's U.S., international, private, public, or even a component of a hedge fund strategy. The equity hedge fund strategies would all be wrapped up in that terminology of global equities, again, to drive total return. Within global fixed income, we use that as a way to mitigate some of the equity risk that's out there in the marketplace. With fixed income managers, both public, private, U.S., international, where there's opportunities. And obviously the challenge there is going to be if rates rise or we start to see credit downgrades. We really haven't seen rates rise in a significant way. We've actually seen them come down quite a bit. If you kind of use the 10-year Treasury as a proxy, we started the year on the 10-year Treasury as 1.92%, came all the way down about 50 basis points or half of 1%, and then now it's around 0.8%. So we've seen somewhat range bound, but a significant drop since the beginning of the year, and that's certainly where we are today in terms of a very range bound fixed income environment. Real assets we utilize from time to time for inflation protection, and certainly the last 10 years that hasn't been as much of a concern, so you won't see that as much in the portfolio. But from time to time, when inflation starts to rear its head, or there's concerns about higher inflation down the road, we'll introduce strategies in the cases of real estate, natural resources, maybe infrastructure, or even Treasury inflation protected securities as ways to defend against higher inflation. And then lastly, the fourth broad category that we diversify amongst is diversifying strategies, essentially active management where we can enhance one of the three former ones, and it's a strategy that's seemingly uncorrelated to global equity or global fixed or real assets. The reason we diversify is that this is a pretty busy chart, but using the periodic table of investment returns, there isn't a always consistent asset class that leads all the time. And so what you're looking at with this chart is essentially calendar years from left to right, 2002 to 2019. The top box would be the best performing asset class, the bottom box being the worst performing asset class. And so the reason we diversify is that there isn't really one compelling asset class all the time beating, although you do have certainly U.S. equities leading the way over the last 10 years. But ironically, if you look back to 2002, and specifically 2003, 2005, 2007, 2009, and even 2017, emerging markets were the best performing asset class. And then as rates have come down over the course of this span of time, you've also seen in periods of time like 2004, 2006, 2012, and 2014, where domestic REITs have been the best performing asset class. Of course, as we know, like I said, U.S. equities have been pretty strong performers too. And again, last year seems like eons ago with regards to all the things that have occurred in 2020 so far. But 2019, we saw U.S. large cap on the far right hand of this chart. U.S. large cap equities were up 31.5%. U.S. mid cap equities were up 30.5%. So again, very strong performance for U.S. equity returns. But we diversify purposely because we're not sure always which one's going to lead nor which one's going to follow. It's better to have exposure to a lot of different areas. As like I said, this ebb and flow occurs globally. So again, from an investment philosophy, we're switching gears to talk about the current market environment. As we look at the returns for the market in third quarter of this year, we kind of reflect on it and really say, at the bottom of the page, you'll see the quarter, 1 year, and 5 year returns for certain indices or asset classes. And again, grouping it into those global equity, global fixed income, real assets, and diversifying strategies. And so if you reflect on why we invest the way we do, it's with the foundation in mind at the heart of it, because at the heart of it, we're trying to cover spending, inflation, so we have real growth of assets, and any kind of investment related expenses. And so for the foundation, that's about a 7.5% return. And when you look over the last 5 years, these different indices in terms of which ones have delivered that type of return, either 7.5 or greater, it's been principally in two categories, the S&P 500 and the emerging markets index, quarter, 1 year, 5 year, all covering that hurdle rate. However, there's also been other asset classes that have struggled to deliver that, and that would be namely in the real assets category, as again, inflation has not been the enemy. It's been really the challenges that the energy infrastructure is going through with regards to supply and demand. And so one of the other things to keep in mind is that, again, we're trying to cover our hurdle rate of 7.5%, but certainly recognizing that these asset classes have delivered varying returns over time. Sometimes in fixed income, we've covered almost the hurdle rate in the last year, but it's certainly not been the case in the last quarter or 5 years. And then when we break down the categories specifically to just what's happened most recently in this quarter, we see things such as the spaghetti graph of colors that we're seeing here for the quarter. But in the most recent quarter, emerging markets have led the way, principally because of just, again, China being a large component of that index, but up 9.5%. U.S. large cap up a respectable 9%, all in this most recent quarter of third quarter this year.
Bill?
And then other areas, yes.
I'm sorry to interrupt, but your screen stopped sharing, so we can no longer see the PowerPoint.
Oh, okay. My apologies. I don't know why it did that, but let me find out why it's doing that.
Let me know if you need one of us to pull up the chart as well, or the PowerPoint.
Okay, can you see it now?
I can.
Okay, sorry about that. Not sure what happened there, but that was kind of interesting. Okay, I will hopefully pick up where we left off right here. So my apologies, but so what I was trying to touch on here was specifically just to capture the third quarter performance and then kind of highlight a couple of things about the markets most recently. Here we're talking about emerging markets and how they've led the way most recently in the quarter. A lot of that being China driven. U.S. large cap, a very respectable 9% return in the third quarter of this year. Certainly one of the trends that's been going on for a while, though, has been U.S. large cap outpacing small cap, and that's kind of reflected in the second bullet point on this slide, where we talked about large cap up nearly 9% in the quarter, almost 400 basis points better than small caps. And then what we've also seen is the trend of growth beating value, and just to put some context into it. So far, year to date, U.S. large cap growth has been beating value by close to 36% year to date through September. Mid caps, it's closer to 27%, and small caps, it's closer to 25%. And it's not just a U.S. phenomenon; it's an international and global phenomenon. International growth is beating value by about 23%, and emerging markets growth is beating emerging markets value by about 27%. So that's the challenge, is that you've literally experienced, in some cases, if you're leaning a lot towards value, a much different return than in 2020 than maybe even a broader index like the S&P 500 or Russell 2000. But just letting people know that we do diversify based on style in addition to asset classes. Fixed income, it's definitely been a far cry from what it used to look like at the end of March of this year, where we had a flight of fear into treasuries. Treasuries looked great, your yields came down. If you didn't hold a whole lot in treasuries, you're experiencing a much different negative return than say what we saw in the bond market in the first quarter of this year. And then, of course, things are starting to reverse with the Fed and monetary policy backstopping a lot of the things in the fixed income market and markets in general. We've seen the risk-on mentality in the bond market ensue. And so this quarter, most recently, the best performing asset class has been high yield or non-investment grade bonds, up 4.6%, followed by bank loans. And then, of course, treasuries have done okay, but they've been close to about 0.1%, 0.2% return. The one thing that's interesting is that we still continue to see in the light blue line here, 3% return out of tips. So I think a lot of folks believe that with all the stimulus going on, in the low rate environment that at some point inflation will rear its head. And so people are buying that insurance protection for bonds. Again, TIPS are an acronym for Treasury Inflation Protected Securities, meant to rise with inflation and protect bond principal there. And then, of course, real assets, what we've seen most recently is commodities have come on in a good quarter, 9% positive, best performing of the group of real assets. And then we continue to see precious metals do well, principally because of gold as another safe haven play along with treasuries. But one of the things we don't see in terms of good performance is in the REIT market. REITs, up in the most recent quarter about 1.2%, but still negative on the year. A lot of that just having to do with the economy and just concerns about certain facets of the REIT or real estate market that are struggling, most notably in the commercial side of things, especially with shopping centers, malls, and the like. And then other sectors are doing quite well, like essentially your data centers, cell towers, and storage. Currency-wise, we've seen with all the stimulus that's been going on, both monetarily and fiscally, we've seen the dollar take a bit of a hit, and that's reflected in the green line down towards the bottom of this chart, where dollar is retreated about 3.5% relative to other currencies. And again, that's to be expected, again, with all the stimulus that's going on here. So switching gears from market developments to key macro developments, what I wanted to share with you here is certainly is good in the sense that, what we see from, the data that's coming from all the COVID-19 weakness is that, some of the data coming through certainly is disappointing to see. And that's kind of captured in the unemployment U3 numbers here on the bottom right of this graph, where if you go back to April, we had unemployment spike to about almost 15%. And then we've seen it slowly come down to around 8%. So 8% is pretty high still, but relatively speaking to where we were in April, it's been on the surprise side of things. And then other data such as like GDP most recently came through for the third quarter up 33% on the heels of a negative 31% contraction in the second quarter. And so those kind of surprises, along with retail sales and some other data points, have at least got the market somewhat optimistic that things aren't nearly as bad as what they had predicted. But one of the other fears, and this kind of feeds into the TIPS comments that I was making earlier, is the fact that money supply, if you look at the upper right-hand graph here, has grown exponentially, up 23%. And so a lot of folks are worried that with this type of supply growth that we're starting to stoke runaway inflation at some point, which should rear its head. And again, that's the concern there. But again, time will tell as to how that plays out. Other data points that I thought were of interest here to share was also the top left graph, where you see the Fed balance sheet in the green line here is spiked with all the stimulus to over 7 trillion. So again, that balance sheet increase has been very dramatic. A lot of the reason why things aren't as bad as they are because you've had all this backstopping of the markets, but you've also had the Fed consequently go to zero essentially on the Fed funds rate, which, again, is starting to be felt at least on a lot of investors' minds, especially when they look at their money market mutual fund returns or their CD rates when the CD comes due. They recognize that, it's not really attractive to get a 1% return as it was a few years ago when you get something more than 1%, but that's pretty much what the market is giving you at this point in juncture. The bottom two graphs are really showing you the implied graph in the orange line, or the implied path of the Fed, which means lower for longer interest rates on the short end of the curve, projecting out to 2023 that the Fed will, barring any other changes, probably keep rates at zero for the time being for the next 3 years. And so again, that does play havoc on folks that are savers and short-term instruments like CDs and money markets, but it also might force folks out of that area into more riskier areas of the market in bonds or possibly in stocks. So it's, again, covering the market, covering macro developments, switching gears to the foundation itself. I mentioned this at the onset of the meeting, but part of the reason why we invest the way we do is just to address the hurdle rate. So every year the foundation is looking to spend on average around 4.5%. They want to cover administrative related expenses, and they also want to keep it in pace with inflation, so you have real growth of assets. We show all our performance returns in our performance reports with the committee net of fees. So again, we don't factor that in, but because it is net of fees, we factor on these three categories, or roughly about a 7.5% return. So a lot of the asset allocation, a lot of the strategies are built around with the context of how do we hit that more often than not, because just because we want 7.5% or need 7.5% doesn't always mean the market's going to deliver on that. And then annually, we go through capital market assumptions about each of the asset classes based on a lot of criteria, a lot of data, historically looking back, but also looking forward in terms of PE ratios on stocks, dividend yield, where are we with interest rates at this point in juncture, where is inflation? And so each of these categories is shown with an expected return as well as expected standard deviation or risk associated with it. And so if you were to overlay the foundation's 7.5% return, you would just kind of say, well, which asset classes, at least when we did this capital market assumptions back in April, would hit that bogey of 7.5%. And you can see U.S. small cap, certainly about a 7.5% return expectation. And a lot of these expectations are out a 7 to 10 year cycle. So we're looking much longer than just the next year. But international equities seem to have the ability to deliver close to a 7.5% return. Private equity, that's why we started to build out a private equity portfolio. And then within fixed income, because of the low yield environment, we're looking at private debt and building out a program there to help kind of complement some of the lower return expectations we're getting out of some of the public bond funds or bond managers that we have. And then you can see some of the others in real assets and diversifying strategies. Diversifying strategies, we use a fund called Weatherlow. It's a hedge fund of fund strategy. It would be at least modeled out in the illiquid diversifying strategies category, another strategy that, again, historically has delivered in excess of a 7.5% type of return. And then, of course, inflation and cash are noted there too. So again, we share these principally annually with the committee so that they understand, what are we projecting out? We're trying to manage expectations. How can we still continue to deliver on a return of 7.5% that we need out of the foundation's portfolio, given what the market is poised to deliver today? And so when I say that, I kind of look at it with an example such as the S&P 500, for example. The S&P 500, when we started the year back when the market kind of tanked, February 19th, the S&P 500 was trading at a valuation of 19 times earnings. So a little bit high based on historical standards. And then after the COVID pandemic hit hard, from February 19th to March 23rd, the PE of the S&P 500 dropped from 19 times earnings down to 13 times earnings. Started looking attractive. And then, of course, all the backstopping and everything else, the stimulus, kind of springboard the S&P 500 forward to today, where as of September 30th, the PE on the S&P 500 forward PE is now at 21.5 times earnings. So it's actually higher than what it was before this all pandemic played out in basically February and March. And so one of the concerns is again, trying to manage expectations that when you have a PE at 21.5 times earnings, and historically that's happened in the marketplace, what does that really ensue in terms of potential returns? That means lower expected returns. And then if you blend that with a yield on the 10-year treasury at 80 basis points as a proxy for bonds, it tells you that, the returns are going to be kind of a slugfest to try to get out a 7.5% return. But again, it is possible to have those type of returns. It's just going to have to go about it a different way than what got us there, the last year, the last 10 years, for example, just because of where we are as a starting point. So that said, again, this is just graphically showing you those same capital market assumptions and showing you that, there isn't a whole slew of asset classes or strategies that are in that 7% north type of return expectation part of this graph. And so we're just trying to manage expectations that, we might get 7.5%, but we should also be not surprised if things don't really pan out the way we want it to, certainly, this year, for example. And so when we model the capital market assumptions based on how we're currently invested, we have a current and a target column here. The broad asset allocation is shown at the top. What we're showing here is that the foundation has about 2/3 of its portfolio in global equities, and then another 25% or so in global fixed income, and then the rest is into that diversifying strategies that I mentioned with the weather low hedge fund of fund strategy. The orange shaded row there takes what they call a 10-year Monte Carlo simulation and takes those assumptions of return and risk and models out, what based on really index type of returns can we expect on average for this type of portfolio given the asset allocation that we have. And that's roughly, if you look at the target, about a 6.8% return. Recognizing that we're not indexed in everything that we do have active managers, and so historically that's added typically another 50 to 100 basis points on top of what the expected return has been. And so, when you kind of blend those two numbers together, the 6.8 plus another 50 to 100 basis points, we're right around that 7.5% return hurdle. And so that kind of is, in a nutshell, is kind of how we're modeling that and communicating and messaging and managing the expectations for the foundation so that they can help manage the money in perpetuity. This shows you a bit broader defined asset allocation, and so it will show the current and target again. Instead of just large cap or global equities as one group, it'll break out all the global equities based on U.S. large cap, mid cap, small cap, international, large and small, et cetera, et cetera. But you can see that information as well. And then finally, from a performance standpoint, again, all this is shown net of fees. What you see here is the performance as of September 30th ending. Very strong quarter, most recent quarter, bouncing back and continues to bounce back from what has been a challenging period of the market. And the year to date, this gets back to my comment about the hurdle rate. If the hurdle rate's 7.5%, we've come short of probably coming into the year with only a quarter left to get a 7.5% return. However, you have to kind of think about where we were at the end of the first quarter. At the end of the first quarter this year, we were down 18%, and the portfolio essentially has come crawling back and 20% positive to, again, be positive 1.4% so far year to date. So very dramatic shock to the system. And we're not the only ones that were affected this way, but we've also seen a dramatic bounce back from where we were at the end of March of this year. And ironically, as you see the second footnote on this slide, the market value of the pooled assets was at $85.2 million at the end of September. We're north of where we were at December, despite, again, the volatility that we saw in the first quarter that had a drawdown of close to 18%. And then historically, longer term, we've come close to, not only beating the market, but beating a market longer term, 10 years and out. And then over periods of time, such as last year and the last 5 years, coming close to hitting that 7.5% hurdle rate, despite what had happened with the drawdown in the pandemic in first quarter of this year. So again, I'll stop there and certainly entertain any kind of questions that I can based on the information I shared, or if there's something else that was on your mind, I'm happy to help out.
So far, there aren't any questions, but please feel free to enter them in the Q&A box or the chat box.
So one of the questions was posted was, what is the name of our firm? It's Fund Evaluation Group, or I guess FEG Investment Advisors is sometimes referred to in the cover of our presentation. You're welcome.
Bill, Karen Klein asked, last year we had a 13% in large cap. This year it's 21.5. Can you explain the allocation move?
Yeah, so the allocation move was really a focus on trying to get more in line with, I think, an asset allocation that we thought was more home country biased. And so from a standpoint of the portfolio, we've tried to focus on, globally investing, but also recognizing that when things don't work out as well as they should, you essentially kind of, start tilting more towards U.S. To look more like what we thought we needed out of the portfolio. So for example, we had a larger exposure to international, emerging markets, international small cap. We went through the asset allocation and revisited that. And like I said earlier, our target based on the new capital market assumptions led us to believe that we could probably still get our 7.5% return using more of U.S. equities than what we thought was the case before. And so that's why there was some readjustment of the portfolio to kind of take advantage of those opportunities in the marketplace. That's, like I said, it's on the quarter, it looks like it's playing out just like what we wanted to. It's a little harder to read on the year to date because of that first quarter being what it was, but quarter and 1 year, very strong returns, starting to see performance, respond quite well. And like I said, we're at a point in juncture that, maybe this time next year, we might have to revisit, well, where do we get our returns from? Do we need to tweak it a little bit? But we try to take advantage of, like I said before, valuations were such that we could get, an allocation with more in U.S. equities and still achieve our goal, our hurdle rate of 7.5. Why not do it? And that tended to play out well. And again, remains to be seen what goes on forward. But like I said, we'll revisit that with our next capital market assumptions asset allocation review at the beginning of the next year.
Well, good afternoon, everybody. My name is Richard Brown, the new CFO for the foundation. It's been wonderful having you here. First, I'd like to thank Bill for the presentation. That's really some wonderful information. And if anyone does have questions, we would be happy to either forward them on to Bill or answer them ourselves in the coming days and weeks. I'm looking forward to working with each of our fund holders, all of our donors and our financial advisors in the coming years. I would ask that as the webinar closes to take just a minute and complete the 3-question survey. This will really help us delivering what it is that you are looking for from the foundation with these presentations. Finally, this meeting is being recorded and we will get it posted soon. So once again, from myself, everyone at the foundation and at FEG, thank you and have a wonderful day.